Okay, housing costs, as we all know, they remain high, which is a stubborn problem for Americans and for the Federal Reserve. Shelter inflation rising 6% from a year ago in January and more than 0.5% from December, making up 2/3 of the monthly increase for the Consumer Price Index. In a recent report, Apollo Global chief economist Torsten Slok, he's noting signs that point to a housing recovery, such as a rebound in prices, could put upward pressure on shelter and then in turn on inflation. Let's talk much more about this with Jeff Taylor, founder and managing director of Mphasis Digital Risk. Jeff, good morning. Great to have you here.
Good morning. Thank you for having me.
All right, so you're forecasting a decline when it comes to mortgage rates over the next 3 quarters. What does that mean when it comes to prices? Because, again, we still have low inventory.
It's a great question. So as I look over the next 3 quarters, I got really 2 data points that I'm looking at. One, we're going to see lower mortgage rates, and then we're going to see probably Fed cuts later this summer. So I look at mortgage rates right now are going to be about 6.9%, right, at Q1, and it's going to go ahead and drop to about 6.1%, I think, by the end of the year, which should create some more affordability in the housing market. Now, obviously, yesterday we had a little bit of a bump from a 6.8% mortgage rate to 7.1%, but I do expect that to taper off here. That was maybe more of a one-day spot. I think that will taper off here going shortly.
So, Jeff, we were just showing the audience your forecast of the rates going down, a few basis points each quarter. How much is that dependent on the Fed cutting rates? And I think a lot of people after that CPI report, they have some doubts about when those rate cuts are going to come and just how deep they're going to be.
So, basically, the mortgage bond market is going to rally well before the Fed cuts rates. So I'm looking for the Fed to cut rates sometime in June. I don't think it's going to happen in March or May. It'll happen in June. But what will happen is, as we see CPI and CPE and CPI start to come under control, you'll see the mortgage bond market rally, and you'll see rates start to drop. If we look back, a year ago, these rates are significantly off the high of October of 2023, or 8%. We're still hovering about 7%. So that affordability factor is starting to work much more in our direction, especially with a job market that's getting stronger.
So, Jeff, the mortgage market. I'm going to push back on you a bit. It's doing more than hovering above 7%. I was looking at Mortgage News Daily. It's right now at 7.13. Yep. That's a good ways above 7%. You're saying, according to your data, the affordable, I'm using air quotes right now for people just listening, the affordable Q2 mortgage rate is 6.625. Why is that a magic number? What about that number makes people who have mortgage rates lower than that sell and create more inventory? What happens when we get to that number?
So listen, it's not a magic number, but if you look at where we were back in October, it was 8%. So 8% to 6.62. We're coming back in a much better area. Also, look at the jobs numbers right now. Okay, unemployment at 3.7%. That's still multi-decade low. So when people feel good about their jobs and they see mortgage rates starting to drop, they'll come back into the housing market saying, is this probably a good time for me to buy? And then you get a Fed rate cut that will probably come in. Again, I'm predicting around June. You start to see more buyers starting to say, I feel comfortable about buying, and sellers saying, maybe this is time for me to trade out of that house that I was thinking to and move into something more affordable and maybe downsizing.
All right. Mphasis says 6.625. Not a magic number, but it's going to create more movement in the housing market. Jeff Taylor, great to have you. Thank you.
Thank you for having me.